What's up, everybody? Good morning. Have you considered taking your couch legs off so Hawkish Paws doesn't hang out there all day? No, it's his safe space. I'm not gonna just blow up his safe space. So what? You guys can have more stream time with him? Is BOJ more important than the Fed? I think so. Yeah, because I don't think JPOW's gonna do anything. Why are you taunting the AI bulls? It's fun. My wife's car and purse got stolen over the weekend, but you included me in your latest clip, so the holiday was a wash. um, I'm sorry to hear that, Brett. Why does de-risking cause market ups? Well, it depends on who's pulling back risk, right? Obviously there's a risk on element on one side of the trade, but remember that everything has a counterparty, right? There's been a lot of stats this week that support that too. $43 billion in losses from short hedge funds over the last month. You have share recalls. You have the market maker squeezing people out, right? As the cover bid gets stronger and stronger on the upside move. Um, so a lot of times, risk off is directional, right? Longs started to risk off back at the end of October, right? Like mid October to the end of October, as we saw prices start to fall below, um, year to date support levels, right? The buy-ins from May and June. We started to see positioning sell off, right? And so that's another kind of risk off, but it really depends directionally. In an event like this, I mean, one thing that didn't change over the last 3 months was the amount of short vol present on the chain. In order to risk off a short volatility position, you need a buyer, or you need something to stabilize the market. And the only way to get that is to push the market beyond the point where the market maker is, positive delta and gamma, right? Because then they can come in and provide the liquidity needed for you to exit those positions. Whereas if you were to exit those positions at the bottom, you would just spike volatility and cause the market to fall even further, even faster. It's cold in SoCal. Well, but you're like leaving, right? Didn't you sell your house? Or are you staying there? You should get used to cold if you're leaving. It's cold other places. Hold on. I had the bright idea of going out earlier this weekend, and I'm 90% sure I got sick again. Do you think holiday sales this year are going to miss expectations big time? Lots of tech department stores reporting very full inventories after Black Friday. I mean, I thought inventories were pretty trimmed for this year, at least compared to last year's inventories. And then some of the early reports look like people are shopping pretty heavily, which is interesting given consumer sentiment's been down. But, the people with money are still spending money. Can Jamie reach $18 again? It's not impossible. It's kind of hard, but not impossible. Was there much charm blood off on Friday weekly expiry? Let me check. So no, Not a lot. Mostly charm. Charm went up there, and then for Friday, maybe like a billion. Not very much. I'm more interested in the fact that we seem to be staying above Vega neutral, especially well on the weekly, right? And so I think we're gonna. I mean, well, we're actually obviously gonna continue to see um, that you know constant short put selling drive the market maker long puts. Like if Friday had been a full day, um, there's I have very little doubt that they would have pushed the market maker long enough puts at 45.50 to drop the market to 45.25. They were already pretty close into the end of the day, and they barely kept it neutral with that like last big pump. So it's kind of an interesting position for them to be in because they can't. I don't think any of the important monthly contracts currently fall in the VIX window. Like December OPEX doesn't. I believe it's now under 22 days to expiry. So all of the short, like the short vol positions, have to be sold on the SPXW chain. They're selling they're selling in the money puts. They're selling out of the money puts. Like the flows are just nonstop put selling, but in there seems to be a little bit of put buying, and that's starting to pick up just a bit. Because shorts are fucked. Rarely. Everyone in the Middle West is sick as fuck. Like with disease, or are you saying because one of those statements I could see being true? What's up, Sir David P? I have money, but I'm not spending it. No problem, Barricase. How are my 45.55 Ps gonna do this week? I mean, you're close enough to the money that they'll probably do pretty well. But we'll go into all the SPX stuff later. I just got a new 65-inch Sony Bravia, and you look fucking incredible on it. No hetero, bro. Thanks, Vupper. I have the same TV as you, but a year older. Is that just volatility traders entering the chat, or protection is cheap, so you're dumb not to? I think it's both. So I think some of the near the money put interest is bearish, right? There's a lot of people still hoping that they can fade the top on this. Um, the further out of the money stuff, it's really hard to tell because all the strikes are so heavily sold. But there does seem to be some persistent interest in long volatility, right? And not necessarily on like VIX itself or SPX, but like in VIX futures, we're still seeing a lot of pressure on that like forward convexity. And so, the assumption is that, VIX is going to go higher in the future, which is a pretty good assumption when VIX is at, all-time lows. However, realized volatility is still significantly above implied volatility. Yeah. So there's arbiters as well. And those will probably be more your vol traders, right? Like people are like looking to dig out that vol alpha. They're going to be trying to play the arbitrage on RVIV. What do you consider the likelihood of OPEC's cuts? Pretty high? Yeah, oil's cheap. They want the price per barrel up. So I think cuts are a guarantee. It's a question of how much and from where, right? Especially with consumption and demand down. And the only country that's not like hurtling or actively hurtling towards a recession right now is the US. And that's mostly just because, well, we're not talking about it, but everyone else is. And, that's going to eventually pressure us given that, a significant portion of like S&P earnings is international, right? If everyone else is in a recession, that's not really going to help our growth. That's on 2.5 to 1 call put ratio VIX. December 20th expiry with fucking 3.6 million calls on the chain for that date. VIX futures or just VIX? Like VIX is a horrible instrument right now. Like I think delta at spot is like zero point 0.7. That's you don't want to buy VIX to go long vol. You're paying like a ton of intrinsic value up front. Yeah, no problem, man. Does Apple have a chance to go down next week? 1700 at Costco. That's where I got mine. Yeah. They're pretty durable too. My cat's knocked it on the floor from standing 3 times, and it's not even broken. Like there's nothing wrong with it. Yeah, I mean, if you're gonna look for long vol, I mean, there's Vega on like SPX or SPY, or I would look into VIX futures or options on VIX futures. Hold on, let me see if I've got. Whoa, the fuck did I just do? That was crazy. Hold on one second. I gotta try to get this. Everything just crashed. Son of a bitch. That was nuts. I don't know what that was. Just gonna log back into some shit because I got logged out of everything. All right, where was I? Can you briefly talk about realized vol versus implied vol? I mean, like its importance. So, well, it's a discrepancy between what the market's actually doing and what's being priced into what the market's doing, right? And so you end up with like a few things going wrong, right? First of all, like options are going to be undervalued because the implied volatility is lower than what's actually happening, and so um, their chance of going in the money is increased relative to their price, at least with most pricing models like Black-Scholes and Sabre and the ones institutions are using. You know, you're gonna have a mispricing in options. You're gonna have people trying to profit off of the mispricing in options, which should theoretically drive up implied volatility, right? Because implied volatility is a measure of essentially the spread on SPX options, or well, VIX is. Um, and then, you know, you get volatility arbiters that come in that, you know, might want to go long volatility because implied volatility is cheap. And with the expectation that implied volatility will exceed realized volatility in the future. Aside from that, it kind of like fucks up risk models. It's a sign that the market might be wrong or overly complacent. Um, it creates a lot of cost-effective hedging, and that's one of the reasons I think it's that we're dealing with kind of a risk-off type of scenario here with this run. Because when you can push vol implied vol below realized vol, you can hedge huge amounts of risk for very little money. And a prolonged period of realized vol being higher than implied volatility can generally lead to like corrections in a similar way that like spot vol being higher than forward vol, right? Where you have like backwardation between spot and VIX futures. Are you looking for in a Vega play? Just high Vega number relative to the others? Yeah, I mean you can calculate like the amount of Vega you're getting per dollar, and there'll be some deals, but you want to make sure that you have enough theta, right? These periods of abnormally low volatility can last quite some time, and it's, you know, it's not a good idea to have too little theta when making bets on volatility. At least a bet that volatility is going to move up. I mostly just grab deep out of the money. Like, well, I don't use SPY. I use SPX, but yeah, usually just like right now I've been buying March, like the March AM contract between 3,600 and 4,000. And then usually, you know, like once they show some signs of profitability, I start scaling out of the position, right? So as vol drops, I scale in. As vol rises, I scale out. Prior to this year and the insane volatility crash that we've experienced, I used to just have a constantly rolling position on VIX, where I would, you know, I would buy deep in the money VIX calls when I thought VIX was kind of bottoming out, through a period, and then I would, you know, roll them out and over as VIX rose, and switch to short VIX when VIX spiked, and then, you know, back and forth and back and forth, and do that as a hedge to my equity positions. But with VIX, you know, mispriced for most of this year, I haven't been able to do that, and so I've been using SPX or VIX futures. Yeah, no problem. Um, I guess we could go over. Got about 40 minutes before I go see what the other nerds are up to. I guess we could go over some of the stocks that we look at. Cat, I still don't think it's very good. I know there were a lot of people, like a couple over the last couple of weeks, that wanted to play the upside of 250. This kind of ran into a lot of resistance and a lot of call selling. Failure here is actually pretty bearish, although I don't see a lot of change in the options interest. So this may just kind of chop and do nothing interesting. If I do see a shift, though, I'll try to make a note of it for everybody. As this kind of falls back below 240, 250. it could slide further, back to that like 225 level. And this will largely accompany probably a loss in breadth, right? So that's what we'd be looking for there is the breadth, which has been pretty good for most of this move to the upside, kind of destabilizing and falling off a bit. Yeah, I don't know if we're gonna get Cat 160 again unless the market crashes, but if it does, I'll probably buy some. GME got the shit shorted out of it on Friday. I still don't see any significant change in either liquidity or cost to borrow. So I would say, and some of this is just kind of an artifact. It's really not spiked up that high. That'll correct. But I mean, this is kind of like peak illiquidity, and some of this, if we're thinking about like the ACH settlement period with XRT, some of this may be in advance of that settlement, right? And so, generally before periods of actual covering on GME, we get a pretty strong short. I wouldn't say last week's was that strong, but it was decent, Um, and so, like back here in March, 2022 might be a slightly better example. We'll kind of bottom, and then before the covering comes in, we'll get another big short. And we're still looking over the next like couple days to see how the holiday impacted any kind of settlement on XRT, and that'll be something um, across most of the retail sector. So it should have an effect kind of everywhere. Upstart's not really important. Fubo still highly dependent on IWM. I don't love it. I think there's enough liquidity that it can get shorted down, and I think IWM's kind of run its course for the time being. So I would be looking for maybe Fubo to start failing the $3 range. It's been long enough without it breaking out. Um, However, if we do get more index upside this week, maybe it'll push up again, but probably stay below 350. Just simply because there's not that much illiquidity, right? Like there's a little bit, and we could get some covering, but I don't think it's going to be crazy. Uh, Thoughts on TSLY? Is that the like the 3x or 1.5x? Oh, the yield max? Uh, I don't know. They just blew up a shitload of their assets under management, selling like 217.50 calls on Tesla. They took a big loss on that. These are okay. These are something that I would buy like after a correction, right? When the dispersion trade is fully moved the other way, shit like this and JEPI and QYLD, those become really attractive. Um, because you get in as dispersion moves back. Or if the market drops, vol rises, and we stay down for a long period of time, these are really attractive. But um, right now, I mean, you probably get better returns just buying the underlying, right? Like year to date performance for this has been, they've done two dividends of 5.85 and 5.7 or 57 cents and 58 cents, right? And Tesla's returned 103% year to date. We can go to Nvidia. Give me a second. Nvidia's actually been kind of breaking down. Part of that is, deleveraging of the like the 500 plus calls that came in before earnings, and people getting out of those. Give me a second. So use credit spreads, Carl. Then you don't have exposure to the underlying. So Nvidia's call interest on Nvidia is kind of collapsing a little bit. Long put interest is picking up. Dealer Delta and Gamma have been falling off. It's still really far away from Gamma neutral, which is at like 443. I would say that Nvidia is likely to stay between 450 to 500 for at least a couple more weeks. There's a ton of call interest that still needs to come off. But it does get a little bit more bearish below 480, which is where it is now. Price action is going to be fighting back against Charm. That could last a while. But I still think 450 and 450 is going to be a really strong support here. On the technical side, below 75, yeah, I mean, it starts to get more bearish, right? And then you'd be looking at breakdowns at like 67 and 60. Breakdown at 60 could confirm, a test at like the 425 level. That's really where the big range is, without a lot of resistance, is kind of between here and here. This is all very choppy. So this could take a while to break down. But if it does get below 450, 460, then it opens up a little bit to the downside. Rut is still mid-range for the year, I think, though. The bull's likely going to ride that to 4,600. The amount of puts sold on NQ and Friday and lack of movement, they have to shift here. Yeah, hard to pump Russell the same way. There's just simply not the liquidity to squeeze out, right? Like last week they tried to pump Russell really, really fucking hard. There was a shitload of out of the money call interest. I think like the most out of the money call interest in the history of the index. And it failed, right? It dropped down to like 175. And fell back below like delta and gamma neutral. And then that interest out of the money is diminished over the last week. So it's it's held at between like 176 and 180, but it hasn't really moved higher. There's just not a lot there, right? People aren't ready to go into defensive. They're not ready to target cash flows. They're still riding high on, QQQ and Mag 7. How much does IB change on SPY in proportion to VIX moving up? I'm looking to do some option strat calcs. I mean, I have no idea what the ratio is, but it should be like the same ratio as it is to SPX. I mean, SPY puts generally are going to be like 1/10 of the Vega of SPX. All right. Apple kind of looks like it's topped. I started selling some bear spreads on this last week. I'm probably going to sell some more on it this week in maybe next week as well. Once Apple hits below uh 185, then I might start targeting it with some short positions. But right now, I kind of want to just sell calls and keep them a little bit above resistance there. Obviously, Apple probably has the most range to go down out of the Mag 7 because they've had the worst guidance, right? Despite this pump, uh, I don't think Apple longs are confident in the growth potential currently priced in, and so we should see more and more call selling come in on it. But it's really slow, so it takes a long time. People generally buy theta on it, so it usually takes a really long time for the options chain to turn around. But I think this is a good opportunity to just kind of sell credit spreads and while it kind of chops around, and then if it starts to drop faster, you can kind of chase a bit. I don't think we have any important earnings this week, Carl. Right? There's Salesforce, Snow. Those will be kind of important. Some retail earnings this week that might matter, like Dollar Tree, Ulta. Oh, CrowdStrike's this week. So software as a service, and then some consumer non-durables, but not much. Yeah, I don't think earnings this week are very important. Let's see. Amazon looks pretty good actually. The call chain there has been slightly improving over the last 3 days. Um, this is still relatively one of the most undervalued of the Mag 7. Um, I think it may have some room for some upside this week, provided indexes behave. Uh, I'll write more about that one tonight. I wanna look at the options chain a little more closely because some of the call interest on it may just be sold. But I know dealer gamma's been picking up, and hmm, actually Friday doesn't look so great. Yeah, that one might be a good opportunity to sell some credit spreads on as well, actually. Victoria's Secret, gross. Um, just because you owned GME once, Carl, doesn't mean that you have to keep buying companies that don't make money. AMD looks pretty good. That might kind of be topping out too. Google's just held this trend forever. um, if this trend breaks, I would probably want to go short Google. It's been it's been a bit of a wild ride over the last few weeks on this. Hmm. Yeah, Google might be a fun one. I'm not really touching Meta except for long dated. Maybe Microsoft. Microsoft might be a good credit spread target as well. Like you don't really want to go short these here so you can confirm that they're breaking down, but calls should still be a bit overpriced, and so there could be some good opportunity selling calls across most of the Mag 7. The problem there is you probably have to close them early this week because we have a bunch of data into the end of the week. We have PCE, which is a big deal. And then we're going to have a Powell speech, I believe, on the 1st. And obviously everyone's going to be hanging on that. And that's this Friday. So if you're selling credit on any of the mags, like credit spreads on the Mag 7, make sure you're looking to get out with like just profits, right? Not worrying about not worrying about just holding them into expiry because there's going to be a lot of risk into the back half of the week. But Bezos says he's going balls deep, selling shares on Amazon. Yeah, I don't know if anyone seems to care yet. At least the options chain doesn't look like they give a shit. That could change, but it looks a little worse as of Friday, but not dramatically so. If I see a bigger drop off in call interest, then I would say, okay, it looks pretty bad. But as long as Bezos hasn't filed a Form 4, no one's going to care, right? When he does, then they'll price it in. Gork, Tesla dead? No. I wish. It's getting closer to dead, but it's still very much above support. This is still the range I'm targeting to enter a Tesla short between like 230 and 227. Until it breaks down there, I'm not buying shit on it. I don't like the upside, and I don't like the downside until it confirms that level. Also like the stream, you buttheads. Yeah, if you guys could, that'd be a big help. QQQ. That's kind of rounding off the top. I'll go more into the... Yeah, I'll go more into the TA for indexes tonight. Yeah, that's about it. Alright, let me see what Dork and JFresh are doing. Anybody have any questions about any other stocks? No. I didn't talk about Siri. We could. The technicals look kind of bullish. We haven't seen any covering on it though, and I really don't like that it's back below $4 or $5. There's still a massive short position there. I mean, the problem I have with this is nothing really ever changes on it. And when we do get covering, it seems to be fairly brief and reverses really quickly. They don't want to risk the stock moving up into like the insanely large call positions to the upside, and so yeah, we've just kind of sat here. Can you give the what mean on why Buffett bought it? I mean, there could be a lot of different reasons. Maybe he's trying to interfere with the buyout. It's possible that he just bought it to lend it, right? I think Sirius like year to date share lending yields are the greatest, or yeah, either the greatest or some of the greatest in the entire S&P. So just yield alone is worthwhile. I mean, the borrow rate on it has stayed pretty consistently above 30% for quite some time now. Plus the dividend on the underlying, right? Express continues to be a wild ride. When is an options chain likely to be introduced? Well, either when there's enough demand or volume for an options chain to be introduced, or the company frees up some liquidity in the form of a share offering. I would say that a share offering that increases the size of the float would be the most likely reason. I think right now the float's a little small. And the OCC may be reticent to open up an options chain on it with it being so illiquid. I think the shares outstanding on it are crazy low. It's like 3.3 million shares now. It's been doing good though. It's recovering. I'd like to see it move back up to the, kind of the prices pre reverse split. It's not going out of business yet, which is it's still its most promising promising point. Nope. Hey guys, hold on.
Trying to figure out if I can hear you guys. You guys here? Dork?
Yeah,
here?
I'm here. What's up?
Oh. Well, I can tell you I'm a little overwhelmed.
Oh, by children?
Well, yeah, I'm walking in the park with my kids, but no, that dude on Twitter, Damp Spring, just told everybody to follow me, so I'm getting like thousands of follows right now.
Oh, nice.
It's a little overwhelming.
Good stuff, man. You're famous. Congrats.
You've gone viral, JFresh.
Oh shit, that's too much. It's too much pressure. I feel like a couple hundred people's about perfect who don't know who I am. Because then, like, if I take my shit posting too far, the damage is fairly contained. Oh well. All right. I gotta figure out how to turn this off.
What, Twitter? You can just delete your account.
I might have to.
Just go full Burry.
Yeah, you just
Anyway,
do the Michael Burry, restart your account once a week, post your DD, and then delete it.
That's I don't know.
Then you'll create an even crazier following.
That's true.
He doesn't mean he means like more crazy people.
Here's what I think should happen. Once I reach like peak, say like 20,000 followers, I start dropping AI art. Just a torrent of hundreds of.
You're just your whole portfolio.
Yeah.
Portfolio.
Anyway, all right. You didn't talk about bonds, so we should probably talk about all that shit.
We could.
And Dork's our bond and credit guy. Anything interesting going on there?
Let me check. Let me just fire up my thing, my laptop.
Well, while he's firing that up, we got to talk about Mama Yelly.
What about
I mean,
her?
obviously, she's been a huge disappointment. Being too scared to issue the debt in a way that's responsible.
Yeah.
But she can only get away with it for so long, and this week's a pretty big issuance week, right? So
yep, we have the 2, the 5, and the
like
7.
Hundreds of billions of it. But I think the biggest thing is it's the size, right? I mean, the 20-year was a pretty good auction last week, but that was because it was like $16 billion.
Yeah, it was super small.
But interestingly, it was like the 6-month or the 1 year. I can't remember what it was. It was one of those like less than a year durations that she sold that everyone just kind of assumes is going to be fine because of RRP and all the money markets that need, liquidity, but some stability. That there was one in there that was really terrible, which was surprising.
Also, the 10-year tips was kind of a shocker.
Yeah, well, I think that's a shocker because that says that people think inflation's going to go up, right?
Yeah.
which isn't great, especially with, I mean, Michigan survey. Well, so the Michigan survey is interesting to me. I don't place much credence in it. First of all, it's got a lot of noise. So one month to another is not super reliable. It also seems like it's, even though it's inflation expectations, it seems to be mostly just how people feel about inflation right now.
Yeah.
It pretty much mirrors current inflation, or even like slightly past inflation. But the fact that that's been kind of creeping up, I think, shows that people feel that their costs have gone up, which is significant, right?
Mhm.
So, I mean, if you take all of those little pieces together, obviously we haven't seen we haven't seen what we were expecting yet in CPI to start ticking back up. I mean, core has been pretty stable. Energy continues to somehow. I can't understand how many more months we're going to get of lower energy prices when energy's just been kind of like waffling in the same area. Like, it
Yeah.
can't just keep going down forever. At some point, it has to bottom.
It can get pretty
Um,
cheap though.
Yeah, that's the thing
yeah,
about oil
but
prices is like
it's got to get actually cheaper at this point for the prices to keep going down, right?
Yeah.
well, that begs the question though, right? The question that you need to ask yourself is why is oil coming down, right? And there could be two reasons, right? Increased supply or decreased demand,
It's
right?
both. It's both. The last like quarterly report showed a massive decline in demand. I think it was like a few 100,000 barrels per month reduced demand. And then it increases broadly increases in supply and stored oil as well. So it was kind of a 1-2 punch. The,
Yeah,
the
and
the
it
only
sounds like
reason the only reason oil's recovered is because of BRICS being kind of elusive.
yeah, they're trying to OPEC's trying to like cut oil production. We had I think it was Saudi Arabia cut oil production
Yeah.
again. So there's definitely some demand issues with oil. And the thing is that puts a dent in the long-term economic growth thesis, right? I mean, oil is not just cars in transit, it's everything.
Yeah, it's
And
a huge indicator, right? I'm
yeah,
sure I'm surprised more like recessionistas haven't been screaming from the rooftops yet. This is like oil dropping's usually their first big signal where they're like, "Oh my god, it's a recession."
well, it's also
Well,
where
they've been getting
first big
dunked on
signal.
for well over a year.
Yeah, well, it's also the first big signal of disinflation,
Yeah.
right? So that's the big like a lot of the bulls are pointing to numbers like CPI and core because they're staying relatively flat, and I get that because those numbers are fairly important, but when you kind of dig down as to why, right? It's a big question that I think people are avoiding having to answer at this point, right? And then that's why you get a lot of soft landing calls at this point, is because we're not really considering that reduced demand, right? Which is exactly what Jay Powell wanted, but they're almost saying that not only are we having reduced demand, but our economy is going to continue to grow with reduced demand. It's just it doesn't make much sense. I'm not exactly sure how how you can sort of go through this explanation in your mind and have it make sense all the way to completion.
Yeah.
It's very frustrating.
I have
But
a real hard time grasping the idea that we are going to grow while every other economy in the world is contracting.
yeah, it's
Like
the whole
somehow our economy is so insulated from like the I guess the assumption is that our economy is completely insulated from the international economy, and it'll have no to negligible effects on us moving forward, which is fucking ridiculous. I mean, the seven largest companies are all huge multinationals, right?
yeah, and I mean the German economy is still in the tank. Like it hasn't really recovered.
You hear they cut funding?
Really?
Yeah, this last week. It's been some time in the making, so it hasn't gotten like a lot of press, right? Because people have gotten bored talking about it. But yeah, basically they're not financing any more government spending.
Yikes. So we're bailing out Germany? Is that what's going to happen?
We might have to.
That's great. That's great.
I mean, it's
I
okay.
love
Germany doesn't do crazy shit when they fall into recessions, right?
I love
Historically,
when I
they've
joke about
never
things.
they've never
that-
been one to overreact to negative economic news.
Oh yeah, yeah, for sure. No, I love when
Here's something that doesn't make sense to me when you talk about like, us versus the rest of the world. I mean, I think it's pretty clear right now that we're being fiscally stimulated. Um,
Harder than a Dan at the Wendy's, yeah.
I mean, it's pretty extreme that the deficits are quite large, and I mean, I know we talked about this at length last week, so we don't need to go into too much detail here again. But what doesn't make sense to me is that a lot of the increases in revenue are due to rising prices because of all the money, right? There's just a lot of money sloshing around, so everybody raised prices. Wages went up, so the response to that to try to increase earnings was to cut jobs, and that process is still ongoing, right? Citibank or
A bunch of
Citibank,
banks, not just Citibank. It's been a couple
bunch of
now.
yeah,
Yeah.
Yeah.
but Citibank's is a notable, very large one. I
Yeah.
mean, 10,000 or so, which is not nothing. Tech continues to sloth people to increase margins. But so what I don't understand is how the hell is employment still so tight? Where are these people going?
Wendy's.
I mean, it must be,
Just to their competition, right? Like I mean, like every time tech does a big round of layoffs, then they hire a bunch more people, right? Didn't
yeah.
that
I
just
mean,
happen like really notably with like one of the like security companies? Like they laid off like 5,000 people and then had to hire them all back.
the Salesforce.
Salesforce, yeah.
Well, they're in the process of that. I don't know if that's going to show up. You mentioned that their earnings are this week, so it'll be interesting to see for that reason, because they had good earnings because they were able to increase margins because they laid a bunch of people off, and then they're like, oh shit, we have all these contracts we actually have to deliver on, so we're going to have to hire them all back. And of course, they had to hire them all back at quite a premium, right? Because they're like, well, I know what the going rate is now, and it's a lot higher if you want
I,
me back.
I mean, there's kind of like a
So,
cycle in the thing you're describing, but go on. Sorry.
yeah, I mean, I don't have much more to say on that other than it's just that all the macro indicators, when you look at them by themselves, are perplexing. Maybe not so perplexing if you believe that the Fed's done nothing, right? Then there's no
Yeah.
reason to believe that unemployment should stay low. But what doesn't make sense is all the numbers together, right? It's like half the numbers show weakness, half the numbers show strength, and it's really hard to identify if half the numbers are wrong, and if so, which half, or if just the whole mechanics of what we expect are wrong, right? Like depending on who you look at, like various people track different types of data, and depending on the data type, I feel like the data type you track is more indicative of whether someone is positive or negative on the future than anything else, right?
Yeah.
And uh, it's just something I really want some clarity on it, because the numbers just don't all make sense together.
Well, so to touch on the labor market conditions, right? We generally see like labor market underperform into the early part of the year with like rising unemployment from like Jan to June, right? And then overperform in the latter half of the year from June to like December, right? And then because we tend to see like big layoffs after the end of the fiscal year. But that's also the time at which companies are announcing all of their buybacks, right?
Are we calling the fiscal year like the Fed year, like October, or when does the fiscal
No,
year end?
just December. Yeah, just the
Oh,
standard.
okay.
Yeah, just end of yeah, not the federal's fiscal schedule. But we tend to see like, and then that's when we see buyback announcements, right? And so it's kind of like buyback announcements support the collapse in margins, or buyback announcements and are supported by rising margins due to the cutting of employment in the beginning of the year, right? And then the second half of the year, margins are supported by the firing of people and the buybacks, right? And so it kind of flip flops, and we saw that really clearly this year. And we should be seeing those buyback flows kind of drop off. They have for the last two, like they spiked really hard on this run, but then down the next week, and they'll probably be down this week once we get the data. And then buybacks will kind of trail off into the end of the year, right? And then they'll start firing people to boost margins in the first half of the year. That makes
Yeah,
sense.
I mean,
I kind
I
of wound through it a bunch of times, but
yeah. So I guess why? So then why are margins still so good? I mean, I guess margins are okay, maybe,
well,
but
margin.
earnings, Q3 earnings were a little bit better than expected, right? Revenue kind of came in below ish expectations, but earnings were a little bit above. What they have done instead is they've started to drop the ridiculous 12% growth next quarter.
Yeah.
So as we have to like actually, square predictions with reality as reality approaches, they have to make them more reasonable. And I think that's the more interesting thing, right? Because revenues are only expected to grow 4% year over year, which is below inflation or at inflation, right? Which implies zero increases in productivity. But earnings are expected to be 12, which has to imply a lot of productivity increases. But it just doesn't make sense, right?
There's the potential for inflation to just go way the fuck up really fast.
Yeah. Well, I mean, I think.
And it can continue to provide productivity, right?
Yeah, I mean, I don't think inflation's really come down. I think we're overstating productivity.
Well, I think we're overstating productivity, and I think also the healthcare costs thing. Like that's ultimately that's really what everyone's leaning on, right? Like CPI should have been pretty flat, which is what we expected this quarter, aside from the change to healthcare costs. But the healthcare cost that's going to rebalance in the beginning of 2024, right? But until then, and it's going to show a rise in healthcare costs over 2023. But until then, it's going to show that inflation is flat to declining, right? It's a deflationary pressure until the extra year is weighted. And then once 2022 falls off, then healthcare costs are going to go up massively, like 0.46, right?
Yeah.
And then they're expected to increase over the course of next year. So that's going to become, right now, since the change, it's deflationary. And then after 2024, it's going to become inflationary. And that's a big part of the consumer spending index, right?
Yeah. I still can't get over how in the last CPI print, sorry, my kids are screaming.
No worries.
I still can't get over how the last index print that lodging was so negative. It was like minus 6%, and it's only like 1% of the whole weighting. I think housing overall is like 33 or 34%, and lodging is 1%. So like 3% of that whole index, but it was so negative. It was like negative 6% or something like that.
Yeah.
That it dragged it down from 0.5% increase month over month to like 0.27. But if you take out the lodging, which could just be that people are strapped for cash and just spending less, traveling less, not necessarily spending less, but just traveling less. That I mean, it's a much larger inflationary pressure than is being perceived. But anyway,
I guess
yeah,
you can like the knock-on effects of the loss. If we're talking about like business people traveling less, going to less meetings, across state lines and things like that, right? Then you're kind of seeing potentially a sort of canary in the coal mine situation.
Well, I saw something interesting that somebody, it was a graph that somebody posted on Twitter. I'll see if I can dig it up later. But it was like TSA check-ins from like October through November. And there was a pretty sharp decline up until the holiday season started, and then it picked up a ton, right? So I think we're still seeing a lot of people spending money, but businesses are maybe contracting a bit. I'd want to look at that data over a longer time period, but yeah, we may be seeing less business travel overall, and that might have an effect on lodging, right? Also, seasonality has a big effect on lodging prices.
yeah, but you'd expect that to be properly accounted for, right, in the
No,
CPI.
not at all.
But here's the other confounding effect, right? There are plenty of people in travel that are saying that they expect demand to be robust, and that are seeing signs of robustness, in this otherwise seemingly negative thing, right? And this is kind of like what I'm talking about. Depending on the data and the things that you follow, you can get two completely different pictures of vastly similar things, right? How can lodging be down so much?
Well, it's domestic
But
lodging, right?
yeah,
There may not be a
there's
lot
some
of
local
there might be a
there.
lot of international travel, right? We have a strong dollar.
That
Um,
could be so. Yeah.
generally a strong dollar and like weak international economies, you're gonna see a lot more people in the U.S. going abroad. Um, and that's if they're going abroad and not traveling into the US. I mean, like, the euro's down, the yen is way down. Like, all of these are really attractive destinations, right? And if you can do that at the same cost as traveling within the confines of the US, why wouldn't you just go international, right?
That's so true. And it's another instance of us exporting our inflation, right?
Yeah, yeah.
So that
Yep.
that actually would kind of be consistent with other things.
I have a buddy, financially literate friends. He's moving to Japan for a little while, and I think part of the reason why is because it's so dang cheap to live there with U.S. dollars.
Yeah, well, I mean, think about converting all of your life savings into yen right now, and then BOJ makes a decision that props yen, right?
Oh yeah, yeah.
And yeah, I mean, you'd just be in a great place, especially if you did all your major purchasing right up front.
Well, he's hedging with yen futures.
Oh, okay.
So yeah, the premium was super worth it for him because he's got all of his finances figured out for for like 2 years or something.
Yeah, I mean, you can like go there, buy a house, right? And everything you buy will be worth more in the next 3 years,
Yeah,
unless Japan really really fucks up.
right. Yeah, and I don't think they will. I think they're pretty aware of what's going on.
Yeah, it seems like a really good opportunity.
Yeah, no, I was happy for him. I was like, you picked the perfect time, and he was like, I know, right? And I was like, you knew. Well,
So when does the stream become a Japan travel stream or
um,
international travel stream?
not yet. I'd have to leave my apartment first.
Yeah, I
Yeah,
know. We're
it's
working on that.
we'll see.
We'll live stream from Japan next
We'll
month.
open the Pickle Financial offices in Tokyo in the financial
Yeah,
district. Yeah.
perfect.
What were you going to say, Dork?
Oh, I was just gonna say, so as the bond guy, not really a whole lot happened last week. In terms of like the bond market, there weren't like any crazy moves anywhere, but we saw high yield spread with AAA stay high all week while the AAA triple B spread dropped. So that's just indicative of there being more demand for higher quality debt and less demand for lower quality debt. Basically, confidence is following the bottom up trend in a weird nonlinear path, sort of how I like laid out like a few weeks ago or something. It's still happening. It's just, with all this leverage that just rolled into the system over the last little bit, it's being used to not only prop up equity markets, but to drive down spreads and make everything look nice and rosy. So that's what they're trying to do. But the high yield is kind of missing the boat on that whole thing. So something interesting to keep an eye out for. That if it does continue up from where it's at, we could be seeing high yield spreads like pretty much already approaching the highs from like the GFC and the 2020 crisis. We're about halfway there. So yeah, any further upside move in high yield spreads would be pretty bad. And I mean honestly, any further like actual upside moves in triple B as well, triple B, triple A. I mean, we're kind of just at the cusp of an actual bearish outlook on corporate bonds as well. So interesting stuff. Keeping an eye on it. The dollar yen direct spread, not the swap, is pretty much as low as it's been since the '98 recession and the 2008 financial crisis. So the cumulative effect of that is going to be inflation up in Japan because their currency is just losing value.
Yeah, their
And
inflation print last week was rough.
well, it was
Um,
it was the combination of inflation and GDP for them that was super
yeah.
rough.
Hold on, let me pull it up real quick. It was
You could just say inflation up, GDP down.
yeah, but it was like year over year inflation was 3.3 to 3.2, right? But month over month was 0.7 versus the prior 0.3. So not only is their inflation turning up, it's turning up really really fast, and then their PMIs missed like across the board on the same day too. So not only are they showing a contraction in their assumed GDP, but there's some indication of contracting in both services and manufacturing sectors, right?
So they're stagflating.
Yeah, but foreign bond investments are up 2.5 billion yen from the prior negative 65.8 billion. So someone's trying to get out of the carry trade.
Yeah, yeah.
They're
It's
oh they're not stagflating. They're like hyperinflate, starting to hyperinflate, right? Because they don't have like flat growth. They have negative growth. So negative growth and rapidly accelerating inflation.
right. Well, I think we need a couple more data points to really kind of confirm these sorts of trends. But I mean, it's pointing to me conservatively to stagflation, right? And yeah, the worst outcome is that they do have declining, GDP while at the same time their prices are continuing to rise out of control. Because I mean, the only choice at that point is to just crush the economy again.
Yeah. I mean, I've talked about it before, but I think Japan benefits a bit from letting their inflation rise somewhat. But they do just because of all the like deflationary effects that are kind of intrinsic to their economy. But not too much, right? If they get too much inflation, it's going to be, especially when that spread between producer and consumer inflation really starts to widen. That becomes a big problem for them.
Yeah, and I mean, in terms of market go up or down, it's really ambiguous, and you can't really make you can make investment decisions based on it, but not like really exciting ones or any sort of predictions about anything, in the near term. But what it does mean is that the Bank of Japan is feeling some pressure to sort of get their currency situation under control, because if they continue to allow their spreads to stay so wide, right? The just it's going to be a constant drag on their currency compared to everybody else's.
I did want to note Friday we saw a big bump in UST yields. It wasn't that substantial, but the fact that it's correlated with the now increase in leverage on the credit spread that's been happening over the last few days makes me think that maybe we're done seeing this cycle of short covering on UST. Which means we may start to see spreads widen out over the next week if they're going to be leveraging down on the carry trade again.
Yeah, how do you think? So does that mean that we're going to get back into a bull steepening cycle again, or what do you think?
Yeah, I mean, I think,
Bips.
yeah, I
Sorry,
think.
Barry.
Well, there's also like the effect of like vol yield rising, and that's also pushing spreads apart, right?
Yeah,
And then against the backdrop that there's nothing to stabilize the spreads. There's no central banks buying, and so the only stabilization effect is coming from prime dealers who we've seen don't really like the current yields very much. And I think this is like, at least especially with this week's duration, where it's really ripe to see more of those fat tails.
if we see more of those, I mean, so the thing is I've heard some people on the YouTubes say that the big tail that printed in September was because of the September effect, when they basically brought seasonality into the mix,
Mm-hmm.
right?
Oh God.
I know, right? Where they said Septembers are generally a low liquidity, month for bonds because reasons.
Yeah, but what
Um,
about the ones in November? Like the
yeah, yeah. So,
the 30
so
year printed like its fattest tail ever, or since like '04, right? After the big run up.
yeah.
Seasonality
So
has gotten out of control.
Yeah,
I
people
know.
really lean
So
on that shit way too hard.
that's the thing is I just if we get more big tails in these bond auctions, it is going to start flashing warning signs to large institutional investors that do buy large quantities of bonds and rely on intraday liquidity from money market funds in order to do their business. They're going to start getting warning signs about liquidity in the market, and we could see further and more reckless, I guess you'd say, just less conservative risk-off behavior. We'll see, we'll probably see the SPX get even more top-heavy, right, as people risk off from the smaller companies that are more reliant on financing. And this is all coming as that debt wave that we keep on bringing up. It's still coming. We're about to run into it in the next 5 months. So it's really looking like we're probably going to have more of those big tail prints, but until we do, there's the excuse of seasonality that everyone's going to lean on, and they're going to use that to make sure they don't have to make any big moves in the near future, right? If anything, they're just going to be slowly taking profits on their good positions.
So, we've talked about Pimco in the past, right?
Yeah.
And without getting into too much detail, Ben Bernanke is now the senior advisor for Pimco,
Of course he is.
and they just went long yen, like in a very big way.
He's the godfather of the worst soft landing in history.
Well, Bill Gross went to like Janus after like 2015 or something, and then I think Ben Bernanke joined as their senior advisor around the same time. But yeah, they just went big long on yen.
Good.
Wow. Oh,
So,
yeah, the global financial market looks like it's like watching a train, right?
It's like watching a train crash in slow motion.
Yeah.
Yeah, like there's like the cliff at the end of the track, and it's like you're not even hitting the brakes, and it's in slow motion, and the engineers behind it are like, "More coal, we need more coal," you know. Yeah, it's pretty crazy. But I mean, my expectations are fairly muted. Just like because these sorts of things, right? What needs to happen for there to be like a dollar collateral crisis is like so many like collateral swaps and currency pair swaps and just all these crazy layers of leverage and margin have to be unwound and go full round robin back to the original the original counterparty in order to really get like a systemic issue, right? If it's just one person in the chain that has to do something, you can sort of snuff out that little tiny fire. But like what happened with SVB and First Republic, right? That they were a pretty large counterparty in some of these sort of things, especially with their gigantic pile of hold to maturity securities, right? That are
Yeah.
collateralized. As those hold to maturity securities get offloaded, right? What happens is the total amount of leverage in the system goes down proportionally.
Yeah.
So there was a very real systemic risk from them, even though they were relatively quote unquote small. With it doesn't take a ton, but it does take unmitigated unwinding for that to happen. So I don't really expect to see that until at some point we just see the market gap down, right? It's really kind of how it works. And then at that point, you can look at currency pairs and yields to sort of get an idea of what just happened. But until then, it's just the market's going to do what it does, which is sell tons of puts and go up.
Yeah, I don't. I'm.
Mm.
I'm not entirely sure that all the put selling's driving up anymore.
Probably
uh,
not.
I'll pass that over to Jay Fresh though, because he
Yeah.
definitely has some things to say about it.
Yeah, I mean, following the same thread that I sort of started pulling on last week of just looking at, whole market dynamics as we start to gather significant amounts of options data. I mean, one thing that's notable is that, well, there's a lot of things actually notable, is that not a lot has changed. And you might think, well, why is that notable? Well, it depends on what has changed and what hasn't changed. So one thing was that the biggest change that happened from the November OPEX is that we dropped a fair amount of call delta from the market, but the put delta stayed relatively stable, right? Because it all just kind of bleeds into zero because it's all deep out of the money and blah blah blah. So OPEX doesn't have a huge effect, didn't have really much of an effect at all on those puts, but the call delta dropped off pretty substantially. It was like 300 billion, or no. Yeah, it was like 100 billion, 200 billion, something like that. It wasn't nothing. But what was interesting is that over the course of this week, they were basically able to get just enough price increase from selling more puts and other things to recover the loss in that call delta. So we're kind of like back to where we were right before November OPEX. And so I thought that was interesting that it was sort of like not really like a progression more than it was just like a survival or a sustainment, I guess is one way to say it. The other thing that is really interesting is something that I added this week to the threads that I'm writing, is looking at the daily volume, right? So in the last one from last week, we were looking at open interest, and that's great for like durable positioning. A lot of the positionings in December, and so that kind of sticks around and tells us sort of like what direction things want to go. The daily volume is interesting to see because it gives us a much shorter duration look, or even intraday look at what participants are doing. Largely because most of the volume is open and closed on the same day, and so it never shows up on the OI. What's interesting is the amount of options traded in terms of dollar value of the contracts, just like the OI, has declined quite substantially from last year to this year, and the leverage is significantly larger. It's up from like 7 last year to like 13 this year. But what's super interesting is that the last time that we popped up to this point back in July, we see very similar dynamics to what we're seeing now, which is in July, what happened was as we started pushing up higher from May or so, up to the peak at 46-ish, leverage started increasing massively while daily volumes started dropping off notably. And the exact same thing is happening now. So we're up to a leverage of like 25x, which is historically very high.
Yeah.
And at the same time, the dollar value traded per day has dropped off even worse than back then, right? And so that's what all of these things are kind of telling me, is that people are sort of set in their positions through December OPEC, which is where most of the OI that exists is sitting, like even out through like Jan and everything else. Like it's all, there's so much concentration in December, it's kind of insane. And so you can, if you put those pieces together, right? I mean, unless we see another surge in, bullish money entering the system from seemingly nowhere, right? Where's it going to come from without more leverage?
Yeah.
And like, seeing like, out off the charts leverage go, which I guess we could see, right? I mean, we've seen weirder. It kind of seems like this is pretty consistent from last week of like, we're going to kind of stay right around here. So I continue to see little upside and large probability of downside. Now, where that downside is going to come from, I don't know. There's some analyses that I'm thinking of trying to sort of get a sense of what's going to happen between now and December. If the assumptions are true that positions are largely set in stone, there's some calculations I can do to kind of see how much more flow are we going to get, specifically from Charm.
Charm's pretty
And
low right now, right? In aggregate.
it's actually, yeah, I mean, it's actually somewhat elevated. It tends to stay
Part of that's
elevated
the
with
end of
me.
month expiry that's this week, right?
Part of it's end of month. Part of it's also leaps, right? So the leaps, because we're approaching the leaps, that effect is starting to show up. So like, for example,
December 15 in Jan.
let me give a comparable example. So back in June, we had a massive, on the SPX chain, we had a massive amount of charm going into the June OPEX, and when that dropped off, I mean, charm dropped off quite dramatically. This time around, off of the November one, we had a pretty decent amount. It was historically quite high. But that dropped off, but dropped down. It only dropped down by like half. So we're still sitting up at like 8 billion a day in flows. If that's true, then this will likely continue pushing up. The problem here, and this is where the great uncertainty comes from, is the assumptions built into that measurement, right? It assumes all puts are bought and all calls are sold.
Yeah.
Which we know is absolutely not true, right? So under the naive assumption, yeah, there's some pretty significant flows headed our way. But I want to like heavily caveat that with it's making some pretty tenuous assumptions. And so trying to figure out what the actual flows are can be kind of difficult. But when you think about where we are, right? I mean, there's already so much value in the call contracts that exist. There's already so many calls. Well, let me. I have a chart. So if you pull up the July call, the SPXW chart I posted for the calls, which is the second chart.
Hold on.
Yeah, let me know when you get it up.
Got it.
Okay. So the blue is from when we were basically at the same point in July. So this is the OI on the calls.
Mm-hmm.
On the SPXW by strike, and then the orange is basically today, or Friday. What's interesting is that there were definitely more calls above us then than there are now.
Yeah.
Um,
if you'd done this chart last week and the week before, it would have looked a little different. But yeah, I'm following along. There were a lot more calls to the upside that fell off.
Yeah, so we're definitely losing calls, or another way to think about it, we have reached this point with less call support to go further. And so this is kind of like when I was talking last week that like everything kind of looks worse this time up here, even though we rocketed up here really quickly. Market breadth is worse, rates are higher, right? Everything's just worse.
Yeah.
So we got here on even weaker technicals, and this is just another example of there's less to go. Either those are short and there's just nothing really left to squeeze, or these are long, and in which case there's less to pull us up, right? But it also kind of tells us that there's nothing really there's nothing left, right? There's just nothing left, and so unless something new moves in, I don't see much more of a push. I mean, I still think 4,600 is about all the gas they're going to try to get out of this. Conversely, if you look at the puts, which I also included up above. Let me know when you pull that up.
Yeah.
That chart's crazy.
Yeah,
it's insane. I mean, other than our boy here up at 5,000, like what the hell's he doing? There's absolutely. I mean, it's so lopsided. It's hilarious, right? I mean, even like the highest accumulation of puts is like below 4,500. So we've become so overextended on all of these contracts. So think about this from a charm perspective. What's going to happen to these contracts, right? Every single put contract is out of the money. Pretty much every single one.
Yeah.
And for calls, let's call it 30% of them are out of the money.
I was looking at this the other day too, and it's like even if we fall to like 4,200, it's not even half of the put OI in the money, right?
Yeah.
It's absurd. It's really absurd.
So puts are super sold, and they're all out of the money, and a lot of them are concentrated at the December OPECs. So what happens to the delta on those calls, which are being used with high leverage to prop up the market? It disappears, right? So that implies that if all of these puts are indeed sold, or most of them are sold, which is likely true given that VIX is low and leverage is high and all the things that we've talked about in the past, then that is going to be a big negative flow that's going to work against upside, right? And that could be quite powerful, actually, because it's so leveraged and it's so concentrated in December. That propping up effect is going to decay quickly, and there's not really anything to stop it, right?
That's something else. It's something else I've noticed is that like the charm breakpoints have been moving closer to spot really, really fast.
Yeah, there's definitely been a huge increase in volatility of charm.
And Gamma
So
Max
yeah,
is just like I don't know where it's going, but it's nowhere near the money anymore.
yeah, Gamma Max is kind of interesting. I think what it's telling us, or what it's been telling us since August, is that, and this is sort of confirmed by the charts we kind of just showed, is
Yeah.
that it's really flat up there, right? So
Yeah.
I mean we're very so Gamma Max. We think about it as a point that's like this this discrete location in space, but it's actually just part of a curve, right? And the curve gets really shallow and really flat before it reaches Gamma Max, and in some cases this can create quite alarming things. I think it was it BBBY like way back in the summer
When it
where
blew
like,
through the max.
well, no, like Gamma Max was like oscillating between like $10.70 or something because of the way that the chain was built.
Oh
Gamma was
yeah.
like flat for like $40, right? But
Yeah.
that doesn't show up when you try to plot just like a maximum point. So what's being missing? So for the SPX, I mean, right now Gamma Max is 47.90, which sounds alarming, but it's been oscillating between that and 4600, which seems much less alarming. And I think what that's telling us is that Gamma is pretty flat between 4600 and 4800 because there's no puts up there and the calls start to kind of drop off. So basically there's like a bunch of call, there's like sort of, yeah, no, there's not. That was old. That was from July. So there's just nothing up there. So 4600, you start to lose the effect of options at all. So you start losing all leverage and you need people to actually buy. And there's just nothing's looking great for more upside here.
Yeah, I gotta agree. Some other notable things over the weekend was that or well into the end of last week was that UBS had announced that they were having some liquidity issues, uh, which is ironic given that they've just released quite an extensive paper on like the liquidity landscape and the global liquidity situation, where they, and I'll post this to the Discord in a little bit, but they kind of discuss like tightening liquidity in the U.S. Treasury market, and how it's affecting positioning, and then also some information about like private market liquidity and how that's affecting like asset valuations, which are then obviously collateralized and traded on public markets, right? And kind of it was kind of a highlighting of like asset managers' need for market participants to adapt their strategies and risk models before this becomes a bigger problem than it currently is. And that was on the 17th, right? And then this week they came out and said that they were having some some liquidity issues over the last few days. Simultaneously, one of the larger Chinese shadow banks it became insolvent with like a net assets of like 40 billion or something, or actively managed assets of 40 billion.
That's a baby bank.
Yeah, that's a little one. But it's interesting because the UBS paper kind of directly addresses China's like FX reserves and how their growth has like stagnated from like 2016 till now, and it's not getting any better. And then now the U.S. isn't investing in global FX reserves, right? So, um, like that market's going to become even more illiquid, and like this is really interesting if you look at like net changes in central bank balance sheets. Here, I'll post this one because it's kind of fascinating. I'll put it in the chat so you guys can see it up close.
Yeah, Jay Fred is
Also,
going to be his readers.
Yeah.
also Dork. Yeah, I didn't. I did just recently. I logged into my computer and saw that you made a joke that I can't see, and now I hope I lose my eyesight just so you feel terrible.
That would be actually awesome. So this is like the net change in central bank balance sheets, with the total outline, but it's, you know, the Fed, BOJ, ECB, PBOC, and Bank of England, all the ones that matter. And as you can see, you know, into 2023, their balance sheets have moved pretty negative, right? As negative as they were in 2022, and arguably worse than they were during the GFC.
I mean, there's an argument that could be made that because the notional values are larger now, right? Relatively speaking, it's about on par.
Okay, yeah, you could make that argument.
But that's certainly interesting, and it deserves some attention.
Now look at the CFTC net 10-year net commercial positioning. Hold on. Wait, did I save that? I did. Okay.
I got pulled off because I was connected with my phone and my computer, but I see this chart that changes central bank balance sheets. Okay, yeah, and then
So this isn't
net
really like a
none.
liquidity issue solely facing U.S. Treasury markets, right? It's kind of everywhere.
Yeah, it looks like a big fat zero though. I think this just speaks to how little the Fed's doing. But it is notable that the Fed isn't acting as the buyer of last resort right now, which is interesting. And now what? Argentina doesn't even have a buyer of last resort. Smart.
Nope, nope. They've blown up there. Yeah, that's the other big news this weekend. Argentina, after electing a crackhead to the office of president, has
Asphalt. It's
basalts.
different. It's
I'm sorry,
classy.
basalts. Basalt addict to office of president has now blown up their central bank. And I don't really know if that's going to have a big effect. There's not a lot of, I mean,
Nobody
Argentina's
cares.
economy has been terrible forever, and there's not a lot of foreign investment there anyway. And, you know, what risk is there is, you know, probably either very well hedged or, um, you know, they don't care about
Yeah.
taking a net loss on it. But having multiple currencies in line ready to peg to the dollar could be really interesting,
Yeah.
especially because Argentina is such a large supplier of oil. And they could very quickly export a lot of their inflation back to us, especially if OPEC were to cut.
Yeah. Well, we all know that all the risk is hiding in the Brazil puts, so it's really Brazil that matters, not Argentina.
Damn it, Jay Fresh.
Yeah,
Wait,
you want to?
were we
So
talking
another
about
chart,
Brazilian puts?
yeah,
Uh,
another macro chart that you might like to see. Go and look at market value of marketable treasury debt on Fred and
oh,
compare
so
that.
many words.
Yeah, that's what it's the MVMT D027 MNFRBDAL on Fred.
Market value of market what?
Market value of marketable treasury debt.
I got it up if you want me to just send it.
Yeah. and look at like just the last few years and
On a
compare
year-over-year
that from like
change or just value?
just value. Look from like September 2020 or like, just 2020 to now.
But that's
All right, I got you.
that's super awesome, right?
And just compare that. Just compare that to the SPX.
So they've leveraged everything they own.
I mean, I just thought it was kind of fun to think about that the SPX and the market value of all treasuries in existence, U.S. treasuries, pretty much follow along quite nicely.
It seems really healthy. This only goes till September, though, right?
I know. I really want to see what it looks like going forward. But yeah, it's all leverage, baby.
Jesus.
It's all margin.
Yeah.
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 Anyway,
That's gross. The U.S. banking
Thanks,
system is
Buffett.
strong and resilient. European system, not so much. Well, this is how we get World War III, right? Germany gets pissed that their currency's tied to Italy's, and they tell the EU to go fuck themselves. At which point, the EU no longer has a currency to stabilize the value of the euro,
yeah.
and Poland decides to attack Ukraine.
Oh, Jesus.
Yep. Oh, another thing. Here's something else. I just want to. This is a nugget I want to plant, and this is really all I have left.
Oh, and
left to say.
Turkey attacks Israel.
Oh, of course, yeah.
Yeah.
So the nugget I want to plant is, and I know this is something that we've kind of ignored, because Rho is the most ignored Greek, and probably
Oh,
way more important than anybody.
I love Rho.
I know you love Rho. I like Rho too. I just haven't really put a lot of time into it because I have nothing. I could come up with all sorts of calculations and theories, but I have no other resource to like bounce it off of or check it because nobody else is following it.
I'm right here.
Well, this is something we should maybe do. But one interesting thing to note is that ever since we can call it the QRA or we can call it Japan, the value of the risk-free rate as priced by the options market, the SPX market, has dropped notably, right? It dropped by about 50 bips.
Yeah.
God damn it.
That's in line with the 2-year, right?
So it's a little tricky. I think I calculated about a year out. If you go too close, it just becomes noisy, right? Because Rho doesn't really affect things if you don't have a lot of duration.
Yeah.
So I think I calculated out about a year. So this would like coincide with like the 1 year.
So you're telling me and Jackson's 12,000 Cs for 2028 are going to print hard?
I think what I'm telling you is that your 12,000 Cs are morphing or affecting the entire market right now.
I don't have
You
that
are
many.
the reason that everybody's tail risks are all off.
Because well, Jackson has more of them than I do, so I blame him.
Okay. I'm not even really sure Jackson's a real person. He's never opened up on a personal level. He's been class act, all business, perfect troll for like a year now.
It's impressive.
It's very beautiful, actually.
He's getting a little bearish, though. Have you noticed that?
Yeah.
He's like trying to sneak.
Treasuries.
He's been sneaking some commentary in, and going treasuries, and he posted some negative things about Tom Lee, which I thought was
Wow.
And since I'm pretty sure he's just Tom Lee, I thought that was suspicious.
Yeah. All right.
No,
well,
you
if
should not
can't
buy
hear
a
my kids
12,000
screaming,
C.
they're becoming ravenous and are actually they've already like threatened to slit my throat if I don't do lunch. So
Okay, so just give us your projection for the week and fuck off.
oh shit, yeah, the projection. Well, last week I predicted down and we went up. So this week I'm gonna predict 4,600 end of week, just draw a straight line, and hopefully we go straight down.
Okay,
Love it.
I like how you think.
So if anybody trades based off that prediction, just know that I made it very clear that it is an inverse J fresh.
This way he can't be wrong.
Right.
Yeah.
If it goes up, I was right, and if it goes down, I was right because it's actually an inverse. So, all right, my kids are literally gonna just start eating each other. So,
all right, go. Feed them.
All right, see you guys.
Get some dino nuggets in your air fryer.
My oven, yes. Yeah. All right, see you guys
later, man.
That guy.
Yeah. So we can. I guess we could start talking about SPX. JFresh is right. We've really hit an upside kind of limit here, and unless some of this data this week provides more liquidity, there's really just not a lot of room left. I think current positioning kind of supports a move to 45.75. Beyond that, I don't see much. I know he put in his prediction for 4,600, but he's basically just trolling. We do have some important data this week. We have Jesus.
I mean,
We have
100 bits away.
Yeah, 4,600 is not that far away, but there's nothing there, right? There's no calls. There's like no calls to squeeze. There's no calls to drive it long. There's some sold puts in the money, but I'm really not sure those are helping anything. And a dynamic that I didn't get to discuss with Jay Fresh here, but we should really talk about, is that the put selling is so extreme and there's so little interest to the upside that the market maker's book is pushing more and more net long puts, to the point where the market maker is actually shedding delta in order to hedge their long put positions. I don't think this is sustainable, right? Like you can't have both anymore. You can't have this high realized vol and this absolutely demolished implied vol, right? Like they've got to let vol kind of breathe at some point. And
I think this is sort of like in a way, this is almost like charm decay, right? Where what's going to happen is volatility exposure to the market maker is going to increase, right?
Yeah, it's similar but a bit different. Well, yeah, okay. Yeah, so, well, as long as they keep selling puts.
Yeah.
But if they stop selling puts, we can't stay at these prices. So it's kind of a catch-22, right? If they keep selling puts, they're going to push the market maker over the edge again and again. And I mean, I know you weren't around for a lot of the like end of day moves this week, but I made a shitload of money just shorting them selling vol throughout the intraday, right? Because we get these big fucking like 30 BPS gap downs, and puts are free at the money, right?
Dude, at the money IV has been crazy.
It's insane. I mean, fucking Thursday I was buying 45.50 puts and 45.55s at like $1 to $1.50.
And yeah, just to put it in perspective again, I did my math wrong last time, but we're looking at you're not looking at $20,000 of leverage. You're looking at $200,000 of leverage being bought and sold for $1.
Yeah.
For $100.
Yeah.
The leverage ratio is insane at the money right now. It's unbelievable.
And you know, I don't see them stopping selling puts. I mean, we've even seen over this last week, we've seen them moving to selling puts in the money in order to get that delta that they can't get out of the money, right? And that credit. But that also means that as we fall, the delta on those sold positions is going to fall off, right?
Yeah, and this is kind of the like what I was thinking about with the whole connection to a pseudo charm, right? Like a Vega charm in a way, right?
Yeah,
Is that especially if we have downside heading into OPECs, right? What's going to happen is just we're going to get rocketing volatility exposure as puts go in the money. And those deltas no longer decay to zero, but they appreciate to -1,
yeah.
right? And that's going to be a huge issue for put sellers unless they you have to buy a bunch of in the money calls to try to prevent this from happening and reduce the overall volatility structure. But it's just with this much leverage in there, I feel like it's just really untenable to try to do that. You almost just have to let it go.
Yeah, and I mean they've tried to support these prices with breadth, and that's kind of been slipping over the last few days. They've tried to support it by buying, selling deeper in the money puts and buying more delta on the call side, and basically they've done everything they can for the last 3 trading days to stabilize price at these levels, but more and more it just feels like it's just going to break down in a far more spectacular way because the concentration is so much different than what we saw from like August to September, right? I mean, like August to September, our concentration was, we had these big like Vega risk levels, right? And they were kind of interspersed like every 25 points, right? With the largest ones, at the OO strikes, right?
Yeah,
And we would kind of drop to the OO, and a bunch of like Vega would get exposed, and VIX would move up a little, and they'd stabilize it, and they'd short it back down, and then we'd lose another like 25 points on the index, and we just kind of walk down and down and down. But the concentration was really well spread out. We had that concentration at like most recently at like 4,200, right? And then 4,300. And they were de-risking the 4,300 and adding to the 41 and 4,000, right? And then somewhere during this run, and it was really after FOMC. It was kind of after Yellen's whole thing, and like just on the back end of the YCC decision here, we started to see the concentration of short puts at the money just skyrocket, right? And now this entire range from like 4550 all the way down to like 4,000 is just stacked with fucking puts. Right? It's not just it's every fucking strike. It's every $5, not every 25, you know? And if this falls into that, volatility is going to pick up at I think a much faster pace than they can short it, right? Like I don't think anybody's planning on controlling the vol to the downside this time. Like it's not structured that way, right?
yeah, for sure. That's it's kind of what I was saying is yeah, because it's such a smooth and slippery ramp down, right? You can't this wasn't constructed with a plan to get it back in line. This was just the craziest ramp ever erected. Not ever, I don't know about ever, but it's an
It's got to be
insane ramp.
it's got to be top 10 or
Oh yeah,
top
at least.
3. It's bigger than June, right? And June was
Yeah.
maybe the craziest one we'd ever seen in our data. And then, if you consider trimming going back, maybe crazier than anything besides like post-COVID crash. But that was supported well, right? Like that was super liquid. That was the Fed. The Fed was pumping money into that. The Fed's pulling money out of this.
Yeah, it's That's the thing is like if anything, all it says is likelihood for upside is just really not there. In terms of it going down, I mean, there's definitely still some way for them to continue to lever into these puts, right? It's on like a hair trigger, right?
Yeah, well, I mean, in the near term, if we drop under 45.36 substantially, that should allow more room to the upside to continue, like for a continuation of this push, right? And that's something I am pretty cautious of, because I think like once we get back under that point where the market maker is going long vol, but they do have to expose themselves to some risk there, right? Like there's no risk-free way of approaching that easing without pushing volatility up, and then
Yeah.
thereby exposing even more risk further on the chain, right? So it's got to be like it's a hell of a knife catch, if they can if they
Yeah.
can pull it off. But I wouldn't put it past them.
Yeah, it's definitely threading the needle with like is like will volatility be muted enough to that downside in order for for us to be able to stabilize its growth and reverse the upside action, right? If there is a pullback and it gets stabilized, yeah, we're probably going to leg up some more, but
And
if
that
volatility gets out of hand, it's going to be a mess.
and it's not like those triggers are far out of the money, right? Like that's probably something else we should discuss here. Is like these are Thursdays, or well, Wednesday nights, uh, neutrals, for like gamma and stuff. These have all moved up, first of all, and then you have the JPM collar at 45.15, which is, I mean, relative to the distance of a potential move, very, very close to the money, right? And then you have the little JPM like baby collar at 45.25. And the big collar is that's a big shift point in the market maker's hedge, right?
Yeah, and there's going to be a lot of positioning as we approach it as well.
And the other thing is, because they're selling the market maker long vol, their time to do this, where it can still be done effectively, is being diminished by relative to the amount of vol they're selling, right? So the longer and longer they sell the long vol or net long vol, the shorter and shorter time frame they have to let this fall back into a range where they can recover, and have a little bit more leverage on the short side of volatility.
In terms of the meatball and the cannoli, it seems like what's happening is our meatball has gotten pretty big and our cannoli has gotten very oblate, right?
Yeah.
So they're trying to keep the meatball on the upper edge of the cannoli without falling off the side and rolling it over. But in order to do that, because it's already starting to tilt over, they have to roll the meatball back a little bit to the other side of the cannoli and hope that the whole thing doesn't just roll over on its side and get all out of whack,
Well, I can
right?
kind of
We're
talk about this, like if we think about it from purely a gamma perspective, right? We have like this is kind of our gamma right now. And well, actually it's a little bit more like this, and then it goes like that, right? And this is like 45.50. And the tricky thing here is that as they sell, so normally, as you sell vol and buy calls, you're changing the shape of this curve, right? You're shallowing the downside, and you're kind of reducing the steepness of the upside, and that allows the meatball to have easier, more linear movement up, right? So it eases the path of the meatball upwards. But in the current conditions, above 45.36, by selling vol and going long short, so you're selling long dated puts to go long short dated calls, you're kind of creating a scenario where the ramp goes like this and starts to, curve back in on itself, which, if something's rolling up, it makes it impossible for it to go further. And then, if you push it further, it's going to fall. Does that make sense?
Right. Yeah. You need like the current structure of the options chain is not necessarily conducive to continued stable upside growth, like continuously without pullbacks,
Yeah.
because implied volatility has gotten so low that there's not much more room for it to go down unless the market just trades completely flat.
So yeah, yeah, we could trade flat for a long enough period of time that the market maker's Vega point rises above spot, and then they can sell vol again without pushing the market maker long vol. But we can't stay at our current price without them selling vol. And that's kind of the catch, right?
Yeah, it's yeah, and it all looks like fairly bearish, but you like if we do get a pullback, you definitely have to keep an eye on VIX and see how it moves because it's going to dictate whether or not we get a continuation back into our more reasonable range of like, what, 4,200.
Yeah. Yeah.
And at that point we could bounce. I
I
mean,
can't watch during the week, and the whole meatball cannoli thing is foreign to me. I can probably figure it out, but I'm very unfamiliar. Slash cry. So basically, what I'm demonstrating is the effect of positioning on the curve of gamma in the chain, and how the market maker has to hedge that. Good morning, John Croissant.
yeah, the meatball is basically spot price.
Yeah, meatball spot, and then the hill that we're looking at is gamma, right? And the market maker's exposure to gamma, and positioning changes the curve of the market maker's exposure. Um, and currently, the way positioning is working is it's inverting the curve of that exposure. So instead of it being a nice smooth slope, it's kind of pulling back into, I don't know, like an ellipse almost, right?
I mean, you could even just describe it as like a vertical wall almost, right? It just gets
Yeah.
steeper and steeper
Well,
and
it actually does inverse at a certain point. Like if you sell, you'd have to sell a lot more vol, but if you sell enough vol, it would flip, right? It would start moving back in on itself, because the market maker would be so long negative delta, like they would be long so many puts that there just would be no upside, right?
yeah. Yeah, it's true.
What's
It's
the
pretty
cannoli?
abstract.
I'm not sure. I mean, a euphemism for a penis, but beyond that, I'm not. I guess we're calling the curve the cannoli.
I don't know. I think it stemmed from the marble on the bowling ball talk, and then
Yeah,
we just meatball into cannoli, and then the cannoli slowly morphed into the gamma curve.
yeah. So the cannoli's round, and the meatball's on it. Except now the
Yeah,
cannoli's like unfolding, and it's no longer round.
if the cannoli, we're about to get into those sci-fi movies where the person folds the paper and sticks the pencil through, aren't we?
Dude, I already did that the other day. I talked about how spot doesn't actually move, just the market maker's positioning. So spot's in like its own, like it's got like its own Alcubierre drive, where market positioning around spot, it changes the location of spot in space time.
Oh,
You missed good shit this week, man.
Damn it! I seriously did.
Yeah, we had to ramp up the meatball analogy. It wasn't proving to be sufficient anymore.
Well, I mean, hey, whatever brings the Dillionaire count up, right?
So far, nothing. Um,
Well, yeah, I mean, that pretty much sums it up. Like, we really like a continuation from here with more upside is like the only way that happens is if Larry Fink decides to buy a bunch of stocks, right? I mean, like, there's nothing on the options chain to support it. And even if Larry bought a bunch of stocks, I'm not even so sure the market maker wouldn't just sell the fuck into it, you know?
yeah, yeah. Which would balance things a little bit.
Yeah, it would be nice, but
Something
yeah,
something else probably important is we're approaching end of month for November, and there's roughly 9.8 billion in
yes. Nah. Hey guys, it's me. I'm here. Can you guys hear me? Probably not. Too bad. Oh, you can hear me. Hey, Carl. Did you guys know Carl's a shill? I did have a good Thanksgiving, Carl. Thank you. I hope you did as well. Can I play my guitar? I could do some elevator music. What do I got? Let's see here. Oh, nope, he's back. I can hear you. Yeah.
hello. Okay, I've got a mic.
I was about to start playing guitar. Thank God you came back.
All right. I don't know what's going off on my camera. I might be gone for the rest of the stream here because it's not turning on. But yeah. So I don't know where I got cut off at.
9.8 billion.
But
Something worth noting. Of
oh
9.8 billion.
yeah. So there's about 9.8 billion in pension fund flows from profit taking into the end of the month, and that should probably be noted. They've hit their like quarterly profit caps, so they're gonna sell off excess ownership.
Yeah, that'll have a damping effect on upside. I don't necessarily know if that's going to mean downside because they'll probably just sell until
It's not
their
a
profit.
lot. Yeah, it's
Yeah.
not a lot.
So I mean, considering how much notional delta is on the fucking options chain, it's kind of a drop in the bucket.
It could offset like a day's worth of charm though.
Yeah.
And then also this week, I believe the little baby collar gets rolled, and the price point on that is gonna be fuck. I can't remember. I think it's 470. Yeah, 47.45 and 42.70.
Okay.
So that's gonna roll. And interestingly, that one was actually in the money previously, but it's just so small. It's like 5,000 contracts, but it is gonna roll, and it's gonna move some things around. Obviously, the puts are gonna move up, so it may be interesting.
Yeah. Well, we ready for weekly predictions, Girk?
Yeah,
I think
yeah,
I've got enough
I think
information
I
now
am.
to shill some puts.
Okay, yeah, let's do that. Oh,
You want
hey,
to do it?
there I am.
Hey.
I'm back.
Uh,
Yeah. So I mean, I really want to preface these with these are not based on any data besides the data that we have as of last week, right? And so I know a lot of you guys like kind of lean into these, at least as an idea. And yeah, they're frequently we frequently do pretty well, but don't. You guys get every week you get every night. I give you an update with like up to date, current, and accurate information and like price projections. Right? Don't look to these, which are largely bullshit and just a contest between me, JFresh, and Dork on who can guess the best. For an idea of market direction, right? There's so many factors that we forget to take into account when making these. It's not even funny. Um, so
Yeah,
yeah, just
my disclaimer stays the same, which is if you make bets based on these predictions, you're a moron.
yes. So don't they're not good for that. So I think tomorrow. Oh shit! Hold on. I got it. Everything just changed. I have this on
Way to
the
go.
one day. Ugh. Okay, I fixed it. All right. So tomorrow, I'm thinking we might we might open a bit. Might open a bit lower. Might open nearer to 45.50. I think the end of the day like rally was kind of stupid. I think tomorrow we can test 45.75 and then maybe close the day out around the 60 range. Tuesday, I don't think there's anything super important, so maybe we fall back to like 50. Wednesday, PCE is the first time I think we see any real movement. And I'm going to go with 25 there. Maybe we see the collar test by Friday. Bounce back to like the 35 level, 40 level for JPAS speech. That might be closer to 50. And then I think JPOW kills shit into the end of the week. All right, that's me.
All right. I'm trying to think of whether or not I want to be bombastic or not. Okay. I think that we open right about spot 45.55, just somewhere around there. We go down Monday to 45.45. I think that's just where we're going to close at. I'm not going to try much with the intraday.
All right.
Next day, we get no movement overnight. We go back up to 45.55. And then Wednesday is PPI. Is that right?
Yeah.
So me naturally being a bear, Wednesday PPI is going to be bearish. It's going to be what's more bearish though? Okay, it's going to be PPI is going to be negative.
Yeah.
It's going to be super bearish because it's going to like just blow out expectations because I'm a bear and that's just what I'm gonna lean on. Market's going to drop about 50 basis points on the news, so that would put us at 40. Is that right? 55. It would be about 40. Yeah, I think that's, or no, it would be 35. So down to 35 end of day. And then
Yeah.
melt up into JPOW's craziness. We'll just move the point later. But yeah, melt up into JPOW's craziness to right about your point, and
Okay.
then down 150 basis points no matter what he says.
All right. So what's 150 from there?
So
It's like
that's about 40,
44.90 something.
something like that. 95. Let's just say I'll be conservative. Yeah, most of my prediction is hinging on me being just a bear
And you wanted
and
this.
everything turning out bearish.
You wanted this at 45.30, right?
35.
35. Okay.
Yeah, and I'm just literally, my assumptions are that there's no pressure to the upside from the options chain, and that the data is going to turn out bearish because fuck the bulls.
Okay.
There you go.
All right. Cool. JFresh gonna win this week? Probably.
Yeah, he's our contra indicator.
Yeah. There are auctions. We did not factor those in. Oh shit! There's a bunch of auctions.
Is there any duration in them?
Yeah, 2, 5, and 7.
Oh, those are
Tomorrow,
kind of loaded, aren't
tomorrow and Tuesday. All right, I'm changing mine.
they?
I think we
You know,
test.
you're gonna hate if I change mine. You're gonna get really mad at me for what I change it to.
What are you changing it to?
JFresh's line. I'm gonna stick with mine, just cause I have to believe that these auctions are gonna go without much of a hitch, and people aren't really gonna care much about them. If they're big prints, like if they come in super soft or the big old tail, that's gonna be extremely interesting. But by that point, all bets are off in my mind. So for me to try to project those, I'm gonna be I don't know. It's either I make JFresh's line on a soft print, or I make, a straight down line on a shitty print. And I like where I'm at.
Yeah,
It
I
makes
like
some
where I am
sense.
too. I think we get a couple tests of the color. But just a couple tests of the color.
Yeah, that makes a lot of sense. Yeah, if there's a shitty auction, then yeah, we'll probably go move down to the collar and trade around there for a while.
Yeah, I like that. All right, cool. Thank you guys. Thank you for coming on, Dork. I appreciate it, man. We can touch later if you're down.
Yes, I'll see if I'm primed and torqued and ready to go.
Okay.
Might be able to be fully primed.
All right, nice. And then thanks, guys. All my bets are in for next week. Assholes.
God damn it.
Thank you guys for tuning in. I'll have Pickles picks out tonight. Probably, I want to say around midnight, but maybe a bit earlier. We'll see. I've got a few like longer term things that I've been looking at that I want to get written up. So it may be a little late. Anyway, yeah, 2 a.m. maybe. We'll see. But they'll be out tonight. For everyone else, I'll see you tomorrow. Thank you guys so much, and have a great night. Later.